and Bulltech Capital Markets Chief Strategist Kathryn Rooney Vera. Great to see you guys this morning. Thanks so much for being here. Kathryn, kicking things off with you. With a market that is trading up again ahead of the latest read on inflation, we've got the consumer price index out in about an hour and a half. Markets are higher across the board. We're expecting a gain of 0.2% month over month and a yearly gain of 8.7%. That would be down from the 9.1% last month, Kathryn. But is that priced into the market? What are you expecting? And what do you say about this rally that will not quit, which started at the end of June?
The market seems to put a lot of credibility in the Fed's ability to bring inflation down to that 2% target without a hard landing, which is unemployment surging and the U.S. being thrown into demand destruction, which is recession. For today's 8:30 print, Maria, I'm expecting about 8.9%. So that's higher than consensus. And that's because that July was a very strong month from the principal driver of inflation, which is demand-driven wage growth. When you have wage growth and slowing productivity, you get wage price spiral. There are still 2 vacancies for every 1 unemployed person, slightly less, about 1.8, but still very high. The labor market is extremely overheated. So what is required, I think, Maria, is going to be that the Fed hikes 75 basis points in September and 25 basis points thereafter. I think the unemployment rate has to go higher to bring inflation back down to the 2% target. And I do suspect that the economy needs to contract in 2023 to achieve that. Now, the Fed has to choose then. Are they going to choose, forcing a rollover in the labor market to get inflation to the 2% target, or are they going to try to avoid another recession? So I think today's data point is going to be really important. I think it's going to be driven by wages and probably housing costs as well. And the market's going to invert in terms of the yield curve if, in fact, we do get what I expect to be a slightly higher than consensus print.
Yeah, we'll see about that. We've certainly seen a slowdown in the broad story, the economy, Keith. I mean, we're looking at the chip makers trying to stabilize after sell-off yesterday. Kathryn, what about that? I mean, you've got a slowing here in terms of the broad economic story, but Keith makes a good point. Semiconductors are in just about everything.
I would take the other side of that trade, Maria. I'm more bearish. I think that this second half is going to provide opportunities to readjust portfolios to make them more defensive going into what I think is a 2023 that's going to be very difficult on the economic front. We are seeing an economic slowdown. Inflation is going to drop, but that's because demand is being destroyed. Inflation is still high. Let's not sing victory and be so excited if we get inflation down to 4.5% by year end. Target's 2. People are still hurting. Real wages are negative. Consumer confidence is very, very low.
Yeah.
So I think that we are going to see a rollover in consumption. I suspect the S&P is going to suffer going into 2023.
Yeah, all really great points for you both. Thank you so much.